Since the March lows, FSLY Stock, ticker symbol FSLY, is up over 677%. This is by far one of the best performers in the stock market that I've come across ever since the market crashed. But what's interesting is that the stock has really accelerated its run up in the last month or so here in June 2020. What is FSLY Stock? Why is the stock doing so well right now? And most importantly, after this huge run up, does this stock still make sense as a good investment? Can we still find value in this company? These are all the questions I want to answer in today's video and more, so stick around, it's going to be a fun one. Guys, whether you're new here or you're a loyal subscriber of the channel, smash that like button down below. Every like helps out a ton and I truly do appreciate it. Alright, so getting right into it, what is FSLY? FSLY is a cloud company that provides developers with a secure and programmable edge cloud platform. This is used to help developers extend their core cloud infrastructure to the edge of the network, which in turn is closer to users. So you may be asking, okay, it sounds cool, but why is this useful? Well, there's a few things that they offer in this platform, including a content delivery network, image optimization, video and streaming, cloud security, and load balancing services. What's great about their platform is that they can be used no matter what the infrastructure of the customer is, whether that's a legacy network that they have, a popular cloud service that they have, or if they have a more private network in place, FSLY is able to provide them value. This table here summarizes that pretty well, showing you improvements in performance, reliability, efficiency, which can eventually be led to cost savings, which appeals to any company. And they've been doing a good job of building big brand names under their belt here as well, with this huge list of customers. Some of the largest providers as well are partners of FSLY, like Microsoft, Amazon, and Google. And then they have customers in the tech space like Slack, Shopify, and Spotify that use their service here today. Now, I will say that this is a pretty complicated business here to understand. You have to pretty much understand networks, deployments, infrastructure, traffic flow. It's not as simple as some of the other businesses that we've covered. So guys, if you feel this is going over your head or it's just kind of boring you out here, this may not be a good business for you to actually consider investing in, because you want to actually understand in depth every single investment that you make. For example, here's a diagram that they show us of how their traffic flows through the network with a ton of technical components like edge routers, load balancers, and some other stuff. And I honestly wouldn't blame you here if you just gloss over this and you're like, this is way too complicated, I don't understand what's going on. Honestly, half the battle with an investment is understanding the business and understanding the product that they sell or the service that they offer. And if you can't understand that, you can't really understand the value that they provide in the marketplace. So for FSLY, I think it rules out a vast majority of investors here on that aspect alone. And that's completely fine. That's why there's thousands of companies out there in the market. If this one doesn't make sense to you, just move on. Now, the other half of an investment is, of course, the fundamentals of a business. You want to make sure that their fundamentals are good, balance sheet is good, they're growing, all that kind of fun stuff. So if you are still here in this video and you do want to learn more about this business and you're able to follow along thus far, let's move on to the fundamentals. So here's some pretty interesting stats they shared with us in May. Revenue is showing no signs of slowing down, growing at 38.2% year over year, and now sits at around $218 million in the last 12 months. Average revenue per customer is up huge as well, which I think is an even more important metric to me, and that's because it tells me that their customers are spending more with the company. This in turn indirectly tells me that customers are finding a ton of value here and they are paying more for their services, more for their offerings, because it either helps them with efficiency or cost or just some aspect of their business that needed improving. No one's going to go out there and spend more money than they have to, so this is a good sign for FSLY. At the bottom here, you can see the annual revenue retention rate is at a whopping 99.3%. They retain almost all the annual revenue that they generate with the customers, which is another important metric in evaluating their customer satisfaction here. What I like seeing here is that their enterprise customers are continuing to grow, most recently sitting at around 297 customers, which make up 88% of their overall revenue here. Even with their current customer base and revenue income, this is still a small potatoes though as to what their true potential is in the market. The industry is around a $35.4 billion giant, split between app services and security at the edge and CDN and streaming, which are two very different use cases that Fastly really caters to, but ultimately is the market and the segment that the business wants to take a big hold of over time. Now, with their current revenue of under 1 billion, they have a long way to go here to capture a good chunk of this market, but to me that signals a lot of growth opportunity. Now, I mentioned this in a couple of other videos where I talk about growth companies, and to me, I find that a company is a good growth company if it's able to grow its revenues by at minimum 20% year over year. Here we can see a breakdown of their revenue growth from 2017, and they have a compounded annual growth rate of 34%, so this definitely qualifies to me as a high growth business. I will keep this in mind when valuing this company in a minute here because it does deserve a premium for this sort of continued growth for the last few years. Another important metric for a company, whether it's high growth or not, is their margins, because this tells me how profitable they can and are right now. And with Fastly, it shows us that they have a gross margin of 57.6%, which is up from 57% from the same period last year. Margins of nearly 60% is very respectable, and I would expect this, to be honest, in any company in the software and cloud space, so this checks off another box here. So by now, I think we have a pretty good understanding of Fastly, the customers that they cater to, the market that they cater to, the services that they offer. We have a good understanding of the growth of the company and the margins that they have as well. But now the next part is typically where I find a lot of businesses fall flat on their face, and that's when we look at their balance sheets and their income statements. This is critical for me. If I don't see a good balance sheet, or if I see some red flags on an income statement, I will not invest in a business. So let's start off with the income statement. First thing we see here is that the revenues were up year over year, which is a good sign, and it has increased by 38% year over year, which is solid. But then when we dig deeper, we see that the cost of earning this extra revenue also grew by 38% year over year. That doesn't look very impressive anymore to me. What this tells me is that they pretty much bought their revenue growth in the last year, and it didn't come organically. The other red flag here that I see is the costs. They are up 40% year over year, so they are spending a lot of money here. Their gross profit was 35.6 million, but their operating expenses were 47.6 million, which is extremely high even for a growth company in my opinion. This all has resulted in a net loss of $12 million in the quarter, which is up from a net loss of 9.7 million in the year before. In summary, their revenues are increasing, but they are spending proportional amounts to keep that revenue growing. Their expenses are growing faster than their revenues are, and their losses are increasing year over year. So there are a few big red flags here in my opinion. Now looking at the balance sheet, this is much, much better. They have cash of around $22.5 million currently sitting in their account, 94 million in marketable securities, and some other short-term investments, which all add up to around $242 million in current assets. Total assets of the business sits at around 323.8 million, so that is a good amount to see here. And even though we know they're burning at around $11-12 million per year, and even though we know that they're burning around $11-12 million a quarter, it's a very small amount when you compare that to their cash and cash equivalent balance here. Liabilities don't look that bad either. 40 million or so in current liabilities, which is easily covered by their current assets, and around 67-68 million in total liabilities, which again is more than covered by their total assets. Overall, I would say this is a very strong balance sheet in my opinion. Lots of cash for this type of business, and even if they continue burning at say 10 million or a bit more than that per quarter, it's still not too much of a concern right now with the amount of cash that they have sitting there, which is around $215 million for all intensive purposes. This means that they can go through around 21 quarters theoretically, losing around $10 million a quarter without having to worry about any sort of bankruptcy fears. So I'll say this, from a fundamental perspective, this looks like a very mixed bag. We see from a high level that the growth is there. We saw them growing quarter after quarter, year after year. But then when we dig deeper into their income statements, we see that they're pretty much buying this growth, which doesn't sit too well with me. A lot of companies are able to do this, but what good is it if your revenues are growing, but then your expenses are growing just as much to keep up with that revenue? It doesn't really make sense here, especially in the short term. But maybe over the long run, what I can see here is that they have some sort of subscription, and over time, those initial costs get smaller and smaller as a percentage of the total revenue brought in. But as of right now, from what I see, they're growing revenue proportional to the amount that they're spending to grow that revenue. I also say this, their balance sheet is phenomenal. It's one of the better balance sheets that I've seen for any business out there. Yes, the numbers aren't great, they aren't in the billions, but this is a fairly small business here, so I wouldn't really expect that. And I think for what they do and what they are, their balance sheet is really good. The only thing though is that, if they keep burning around $10 million or so every quarter, it is going to eventually catch up. It's going to be a lot of time before it does. But I mean, it's like almost like a ticking time bomb, right? Like you have this much cash and you just keep getting closer and closer and closer to the amount that you're burning, to the amount of cash that you have. Not really a great thing to see as an investor, but who knows, maybe in the next couple of years, they're able to actually turn things around in the business and actually become profitable. Now remember earlier how I said this company should be trading at a premium because of its growth rate? Well, let's take a look at their market cap here. And we can see that they're currently sitting at around a $9 billion market cap, but they only bring in around $200 million in revenue on an annual basis. So that means they trade at a premium of 45x. I typically look for this number to be around a 2x or so for an undervalued business, or around a 2 to 4x for a fairly valued business. Even if we add in a premium here considering its revenue growth, at a 45x premium is just too far out there to justify. In March, the stock had around a $1.82 billion market cap, and this put its premium at around a 9.1x. Even that amount I would consider to be high, but for a growth stock, there could be some arguments made there that it was a decent value at the time. But for it to balloon from around 1.8 billion to 9 billion in just 3 months, guys, I can't really sit here and say that I can justify the value in the company today. Guys, FSLY is a very interesting business. It's in a space that's going to continue growing in my opinion. They're after cloud and all these kind of like trends that are growing over time. But what I will say is that their valuation today is just out of whack. It doesn't make sense to me. I can't justify it. And this company just looks too expensive for what it does today. I know that in this market, companies are trading at some absurd valuations, but that does not mean that they're a good buy, at least not to me. So in this situation, I think that FSLY at today's values for the amount that they earn and their market cap that they're at is a hard pass for me. If you disagree with me, let me know in the comment section down below. I love hearing your opinions on, why this is a good stock to own or why this is a bad stock to own. If there's anything that I missed, let me know in the comment section down below as well. But either way, guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.